Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and today I got a very special guest. I'm speaking with Ike Iossif of MarketViews.tv. How you doing today, Ike?
I'm doing good, Mike.
Well,
Thank you.
thanks.
How about yourself?
I'm doing good. Thanks for taking the time to talk with me and everyone else. It's been a little while since we last spoke, and even though we speak more regularly in private, but I wanted to get your take today on what's going on with gold and the mining stocks. We saw the stock market take a tumble in the first quarter and gold go up, but it also went up around this news of Russia invading Ukraine. And in the past, gold would just only have temporary moves on geopolitical events and pull back. So there's a lot of people, not that excited about the recent moves in gold. They're not thinking it's the start of a move like what we saw in 2002.
Well, the truth is, back then, gold was much cheaper than it is now. Nevertheless, for me, Mike, the question is one of risk. Right now, we have two factors that are helping gold. One is the geopolitical crisis. The other one is intensifying inflationary pressures. Both of them are providing a bid for gold, and they are a hedge for risk stemming from these two factors. Also, in about 3-4 weeks, we're going to have to start dealing with a Fed that will probably be a lot more aggressive in raising rates than what we have seen in the past. That is not positive for gold. And if we do have a recession next year, and that's a long time from now, 12 months in the markets an eternity, that is also not positive for gold. So you have two factors that are positive and two that are negative. In other words, there is risk in owning gold, and there's risk in not owning gold. That's how I frame the question. Now, investors have to answer this question for themselves. Which risk do they want to take? The one of owning gold or the one of not owning gold? I mean, I know the answer for myself. Every investor has to answer that for himself.
Well, when you look at it like that, what is the risk of not owning gold? Like, why would gold be necessary for someone to own if there is a lot of inflation or geopolitical risk?
Well, in the past, when we have had inflation persisting, gold had risen. And also when we have had times of continuous geopolitical crisis, gold has done well too. We do not know how long this crisis is going to last, and we do not know if it's going to get worse or if it's going to get better. Now, if we were having this conversation on February 23rd, wouldn't you want, at that time, if you did not own any gold, wouldn't you want to own some, knowing what happened afterwards? Well, that's the risk of not owning gold. Gold has outperformed the stock market and the bond market since February the 24th.
Well, me personally, I was 50-50 I had 50% of my money in bonds and CDs that were short-term and rolling over. And because interest rates were going up and inflation was increasing, as we came into the end of this year, I shifted more of that money into gold and silver in January and early February, because at that time I thought the bonds just are a disaster because of inflation, and it's a bond bear market, and gold is less volatile than the stock market. When the stock market crashed in 2020, the S&P fell like 33% and gold fell 10%. And as you said, gold tends to go up in times of inflation. So for me, it was like an alternative to having half my money in CDs and bonds.
Yeah, as I said, the question is not whether gold is going to go to 2,200 or 2,300 or to 1,800 or 1,750 for that matter. The question is one of risk. The risk in owning it, the risk in not owning it. Which one do you want to take? If you frame the question that way, it's easier to get the answer.
Right. Yeah, I think that makes a lot of sense. Well, there's also, this year mining stocks have done really well. Newmont Mining started the year around 58. It's gone to 84. It's one of the top gaining stocks year to date inside the S&P 500. What is your take on what's going on with the mining stocks and the XAU mining stock index too? I've got a email you sent me a couple days ago with your money flow indicator.
Well, for those who do not know what this indicator is, it's a different way of looking at up and down volume. What we'll look at is the dollar volume of the up and down volume as a percentage of the dollar volume of the total volume. And the reason is, I believe, when somebody places an order to buy 100 shares of a $1 stock, that's $100 transaction. When somebody places an order to buy 100 shares of $1,000 stock, that's a $100,000 transaction. The two cannot count the same. So that is why in this indicator, what we do, we take into consideration the dollar volume of the volume. And what we have seen the last few weeks after the rally is a negative divergence. The interesting thing is we get the same kind of pattern near tops or near consolidations. Like, for example, if you look at period B, that was the rally we got only in November of 2021, okay? But also we had something similar back in May of 2020. And it actually consolidated and moved higher, okay? The question is, okay, when you get this pattern, which one of the two is it? Are we looking at the top or are we looking at the consolidation? Well, you got to put things in context. Given the size of the rally and the fact that it came after a triple bottom, the odds of this being the top is less than 30%, okay? The most likely scenario, and most likely, it doesn't mean 100%. It means most likely. People tend to forget that. We're talking about probability here. I'm talking about the 70% probability. 70% probability is not 100, it's just 70. But there's 70% probability here that XAU will move higher. And what we will see this indicator perhaps coming down a little lower, but not falling behind the equilibrium line, which is the 50%. So the probability are in favor that the rally in XAU will continue. It's about 70%. There's still 30% probability may not happen. But in this business, we make decisions based upon probable scenarios. And this is the most probable right now.
Well, and historically, the action in the mining stocks tends to lead the action in gold. So if the XAU were falling, that would be a negative, a warning for gold. But your analysis seemed to indicate that the odds favor the mining stocks continue to perform well, which would also be a positive for gold too.
Well, Mike, if you look at the decline in 2008 and in 2016 and in 2018 and again 2020, when the stock market in general fell precipitously, so did gold stocks. But then they recovered much quicker and they outperformed. If we do get a waterfall decline in the equity markets in the next few weeks, I'm saying if, I believe gold stocks will go along for the ride, but they will see higher price as well. That is not going to be the same with the stock market. So if you look at the performance of the XAU coming out of bottoms, it has outperformed the stock market. So yeah, I think gold stocks could be vulnerable if you get a 10-15% decline over the next few weeks. But I would expect a higher high afterwards. I would not expect the same thing for the stock market.
Which that all factors into a risk-reward scenario. You think of those terms too.
Yeah.
Well, it's definitely interesting times where I would say risks in the markets are much higher this year than they were last year. That's for sure.
Yeah, and I don't think people who have come through the markets the last 2-3 years can really appreciate the risk that is embedded into the equity markets right at this moment.
Well, I agree 100% with that. I look at the top holdings on Robinhood, and they're still chasing the same stocks they were a year ago. It's pretty wild. Well, thanks for taking the time to talk to me and everyone else. And as we wrap up, could you tell people where to go to get more information from you and what you can provide for people?
Thank you, Mike. Oh, they can go to marketviews.tv and they get my own analysis as well as regular interviews that I do with about 20 colleagues of ours on a regular basis. Therefore, they have, in my view, a more complete picture.
I agree, and I listen to it myself and take advantage of it and recommend everyone else do so too.
Thank you, Mike.
Thank you.